Mark, I'd now like you to come to the stage, and we'll open it up to Q&A.
Stuart, Mark, back here. Mike Dudas, Vertical Research.
Mike.
Hi,
Hey, Mike.
Stuart. Okay. First off, thank you very much. You guys did a terrific job today in portraying the KBR story in a new and very enlightening for all of us. I would hope we would agree. When I think it's interesting when you see other companies talk about capital allocation, you rarely see share repurchase or dividend, then acquisition. It's usually, oh, we're going to look at all this, and if we can't find anywhere else to buy, we will buy back our own stock or capital. So I want just maybe you could share like your thought about that. And when you talk historically about scale, it seems like you feel like you have the scale to compete in, say, the government business and the energy business of what you have now, and can meet these obviously these organic growth targets very comfortably without having to, push the envelope on bringing on other assets.
So, yeah, so I think that where we are today, Mike, is that we've done a number of acquisitions. Our acquisition philosophy has been one that we actually buy for what I would call revenue synergy. So we're not going out and displacing people. We really want people to feel good about the future, so 1 + 1 is greater than 2, and I think that's been hugely successful. So that's the first thing I'd say in terms of acquisitive growth. But we're now in a point where we've but acquisitions are risky, right? You all know that. You've seen that as you go through the acquisitive process, unless you get the cultural piece right and the integration work correct, they are risky, and usually you see a dip in revenue, and maybe through time it comes up. We've managed to keep going like this because of our approach. But ultimately they are risky. And we're now in a situation where if you look at what Mark presented, we feel really good about our targets. We feel that we can achieve those targets. And I think that in some areas one could argue they're prudent or conservative. And we don't need to take on acquisitive risk unless it's hugely compelling to really outpace the industry and really sort of take the company forward. And at the same time, the markets are really supporting that dynamic. So you've kind of got everything going in the right direction. And as a consequence of that, what do we do with all this cash? Because we've purposely built the business and positioned the business in industries that throw off cash. And we've got maybe some big upside coming on an excess of the government, but even excluding that, as Mark said, free cash flow is fantastic. And he's worn me down. He's worn me down week on week for the last 2 years about returning capital to shareholders. And actually, it's quite correct. Probably the best value we can do on a per share basis is take that free cash flow, and we've modeled out only using half of it. So he's not worn me down that much yet, but only modeled half of it in terms of actually what that can do from an earnings per share perspective. And I think it's exactly right. But don't think for a second that we're not out there, as I always say, kissing lots of frogs and talking to different companies about something that could be spectacular from an M&A perspective, but it would have to be hugely accretive for us to actually change course.
And just to maybe follow up on the claim revenues that you anticipate that will be coming in, but the timing we're not quite sure about, is that going to be specially allocated? Is that going to take back the debt that you brought on for it? Just like, how do you think about those extras relative to what you laid out here for us today? Thank you.
I think you just look at it to be very consistent. We're trying to be consistent in all that we do. So if we get cash out of Ixis earlier because we reach settlements or whatever, or legal results, then what we do, we de-lever to 2.75 and buy back stock.
Hi, Stuart and Mark. I appreciate how you laid out everything today and how you're very conservative in all of your assumptions. I'd like to just ask a question about the growth rates that you guys have for government services for the next 4 years and try and maybe peel back the onion a little bit. When I look at what I see in the government services business, I see an amazing win you guys just got with LogCap 5 versus what you had with 4, with having 3 geographies instead of the 1. I see a quarter you guys just printed with 22% organic revenue growth. And I'm not trying to be too greedy with you guys and necessarily expect 22% revenue growth plus the growth of LogCap 5. But you could argue that the increase just from that one project alone gets you a long way towards that 6 to 10% growth over the next 4 years, starting with 2020 and continuing, for the next decade beyond there. And I'm just trying to understand: are there other government projects that are falling off that are keeping the growth rate aside from that close to zero?
No. No. So, I mean, the average growth rate, if you look across the government services peer group, is the best. The best is probably doing about 6 or 7% growth in terms of their performance. We set our expectations above that. You're right, Joe. We're doing far better than that today. We've got backlog to support continued growth through the piece. But remember, these targets are out till 2022. Do I think we can do better? Yes. Is it better to underpromise and overdeliver? Of course it is. And I think, when you roll it all up and you've got 14 to 18% CAGR across our EPS, it's a pretty strong performance. And if we do better than that, you'll be happy. If we do worse than that, you won't be happy. It's all about setting out expectations that are achievable and that are in line with the market dynamics that are in front of us. And I think that's what we've done. But you're right. We've done very well in the recent past, and we'll continue to try and do as well going forward. Is that fair, Mark?
Perfectly fair. I think I'll add just a little more color, Joe. Just to be very clear, we did post 22% organic growth in Q1, but 9 percentage points was a temporary project, our great support to the Tyndall Air Force Base. So really more normatively 13. That's still darn good. But as we grow, it becomes more difficult to produce the same numbers over and over again. The wall gets higher, if you will.
Yeah,
so we did
true.
factor that in to some degree. On LogCap 5, we'll go through a protracted process here. I'm sure this question is going to come up. We are assuming some uplift from our additional scope. When you look at all the data points we can see relative to Afghanistan activity, NORTHCOM, European Command, it's reasonable to expect an uptick from where we're performing today on LogCap 4. But it's also hard to predict. And we've been very cautious in the out years once we get going on our new role in LogCap 5 because it is hard to predict. And so, there is some dependency on troop levels. They've been very constant in Afghanistan for a number of years now. So it's reasonable to predict it will take over at a similar fashion than the incumbent. But we're scaling that back in the out years in those numbers just to be conservative. We have other things kicking in. We think we're going to do better in NASA and other places like that. And so that's all into the mix, but I think we've taken a prudent and balanced approach.
Thank you.
Hi, Lucy Guo with Cowen again. Question for Mark. So congrats on raising many of your targets. It's tough to pick on. The one thing that didn't change was cash conversion, 90 to 110%. Can you talk about any opportunities there may be there?
Thank you, Lucy. So this has been right. Our cash conversion has been consistently achieved. I don't want to get overly involved in it, but when you take our our net income, you add back depreciation and amortization, that's where you would kind of start. And in a no-growth environment, you should generally produce that sort of cash flow. We do have our pension funding requirement that removes about 40 million of that kind of off the table. That's really not in the P&L. And so that's one of the headwinds we have to consider. And then, of course, we consider just growth in the business, at 6 to 10% on the government side and, 10 to 14 overall. There is a working capital investment required there. We still expect to be commercially astute and get advances whenever we can. I think that is an upside. I was very careful to exclude in that whole analysis advances that we might get on projects that we don't particularly know of. And so that would be an upside aesthetically, but it doesn't mean we can spend it. So we just thought we'd take a simple approach and use the kind of historical convert rate. I think that our DSOs actually could improve on the government side, and we're working very hard at that.
Yeah.
There probably is not a lot of upside in the technology and energy solutions part. Given who we work with there, it's very global. There's some customs involved, and that's difficult. But I think Byron and his team and all of us as a team are working on getting that down sensibly over time.
That's good.
That's probably an upside to that equation.
Sure, the other Byron here today, Byron Callen, Capital Alpha Partners.
Welcome, Byron.
Is $4 billion the right size to grow this business organically? You think about some of the consolidations occurred in other federal providers, GD, CSRA, your former employer, Mark, the Leidos deal. Do you need to be bigger? Are you seeing some changes because of the scale of some of these larger enterprises, or is $4 billion where you really need to grow organically the best platform to grow from?
Yeah, I mean, it's an interesting question. I think there probably is it becomes very difficult to grow if you become, Leidos type size, and I think they've got that type challenge. Where we are today, we see plenty of headroom for growth. I think we're now a player where we can punch at the right weight for the size of programs we're going after. We don't see any constraint there at all. So I think that's also encouraging. And the other piece that's very different, and I think Mark talked about this earlier on, is our international business. There's a lot of companies out there that don't have that unique sort of long-term PFI bedrock of business that allows us not only sort of security of backlog, but actually amazingly strong returns into the future. So I think to answer your question, have we got to critical mass that we can actually fight in the big league? And the answer is yes. Are we very focused on deep domains where we've got competitive advantage? The answer is yes. And can we grow that business in the sort of rates that we set out? We feel very confident we can.
Hi. I guess two questions. One, on the energy solutions business, Mark, you lowered the margin target, from I think high single digit to mid single digit, and I'm just trying.
High to mid.
Okay, but you lowered it, correct? So, but I guess my question is, I'm trying to understand the message there, because if we think about the services business, obviously that has very good margins. So you're lowering it because of Farhan's or the delivery business, which theoretically has more risk.
Yep.
So, what, you know what I mean? Like, why shouldn't we expect a better margin return given the risk profile of those businesses? I'm just trying to understand the message there. Or is it the variability in the margins could be larger? I'm just trying to understand the message that you're trying to communicate there. And then my second question, I guess, Stuart, is to you in terms of, I understand you're trying to get us to appreciate the portfolio of the business and the changes that you've made, but as you think about the portfolio, do you care where the growth is coming from? You obviously have good growth across all three segments, but do you want to keep government services a larger percentage of the business going forward, just because of the recurring cash flow or lower risk relative to potentially the energy business? I'm just trying to think how you think about managing for risk and growth across the segments.
Great question on margins, and I'm actually really glad you asked it, because I could have made it clearer. So Jay's services portion of the energy solutions business does have strong margins. We do not foresee a change to that, and it's a big chunk of the pie as we illuminated today. So no change there, but what we are saying is we only have a 4-year window in our planning horizon, and many of the projects we're talking about with Farhan they will go beyond that from when they start. They'll start in 2020, 2021, 2022, and they're multi-year projects. And while we expect at the end of those projects to make money and actually make an attractive return, which would not be in the mid-single digits, the booking position coming out of the gate is going to be in the mid-single digits, because we do a lot of funded liabilities and reserves just to make sure that we're not getting ahead of ourselves. Others have. We're not going to do that. And through the 4-year limited window, it has the effect of that dilutive percentage. But with the profit dollars that are possible from the volumes that can be had in that area, I think it's very interesting from an EPS perspective, should we decide to undertake that.
Yeah, and there's one other factor that we're seeing on the reimbursable EPCs. There's a lot of pass-through revenue.
Thank you.
And so therefore, you're buying things on your paper, but with no risk, if you like, but therefore no margin or very small margins on the pass-through revenue. So that suppresses your overall margin. So we're seeing a bit of that on the sort of larger reimbursable EPCs, but that's good news. It's not bad news. And if you strip those out, then obviously the margins bump up a bit. I mean, I think that yes, I do. You know, we've set out our stall very clearly today. We've talked about KBR overall in terms of the 14 to 18% CAGR growth on EPS, but we've also underneath that laid out what we think we can do in each business. I mean, I think it's you know, I really want the technology business to continue to grow at those you know, mid double-digit type levels, because you know why? It makes mid-20 margins. It's got negative working capital. It's a terrific business, you know, and you know, we really want to see that growing. The government business is, you know, really allows us the big platform of stability into the future, and as you say, allows us to turn free cash flow back to shareholders. But we announced, I think, Sadara and SATORP today in terms of long-term maintenance programs in Saudi. The characteristics are exactly the same as the government business, you know, in terms of the margin returns are actually probably a little bit better, but in terms of the long-term nature of those contracts and the free cash flow profile once you're up and running is terrific. So we kind of want to see the growth in each of the sectors as we laid it out. And of course, the fastest growing sector is energy solutions.
Yeah. We'll take from Steve, and then we'll wrap up.
Thanks, Steve Fisher, UBS. Just maybe a follow-up to Jamie's question there. In thinking about the energy solutions growth relative to investor perception and the multiple impact on valuation to the stock, I mean, you talked about 20 to 30%, 20% without LNG, 30% with one LNG. Think, you know, just trying to probability weight the likelihood of achieving that and investor perception around that. Would 20% growth without the worries about risk on fixed price LNG projects be better than having 30% but a much higher percentage of risk of losing money? And I know it may not be your own perception of losing money because you know what
when we were going through potential Q&A, we knew someone would ask that question, because you're looking at you know, a 2-3% bump in EPS returns for one LNG with elements of risk. And I think what we tried to lay out today, Steve, was look, we can grow this business without doing something stupid. We can grow this business amazingly well without having to book backlog for the sake of booking backlog, or booking backlog just to get cash in the door. We don't need to do it. You know, we don't need to do it for advances. We're in real good shape. And so if we did go into that arena, you know, I think I was talking to someone earlier on, we'll come back and tell you exactly what the deal is. You know, we want to be in a position where we actually want to make money on these jobs, and we're not doing it unless we can make money. And you talk about elements of risk that are, you know, the contract itself, the risk that's within the contract is actually what's key. It's not just, is it lump sum or is it not lump sum? It's a case of what risk are you really passing on to the customer, things like weather or schedule or whatever it might be. And you know, where's that balance of risk sit? So I think the answer to the question is we'll only do it if it makes sense, and if it does make sense, then we probably should do it, because we've never lost money doing LNG. We're not out there saying that we're building power plants on an EPC lump sum basis. We're only doing it in areas where we've actually got a proven track record and an intrinsic in-house capability to deliver it.
Thank you.
Does that make sense?
Yes.
Good. No, I mean, just to close, thank you very much for taking the time to listen. We are, of course, open to any questions, any approach, any clarification you may have. And yeah, no, thank you for your interest in KBR. Thank you very much.